Chapter 4, we will get into the details of our income statement, comprehensive income, and then we really just touch on the statement of cash flows. We don't get into really a ton of detail there. There will be a future chapter that gets into it in more. So our income statement reports, do I have one more? Yeah. Our income statement reports our operations, basically what our net income is, our operating revenues less our expenses. And it will be grouped and detailed in a different way to kind of show you the operating versus things that are more extraordinary in nature. Our comprehensive income is going to be gains and losses that are excluded from the income statement for, again, GAAP type reasons. And then our statement of cash flow takes kind of all of the accrual-based accounting out of it and looks at, okay, what is our cash coming in and what is our cash going out, and kind of classifies that as what type it is. So here we've got an example of the income statement. So this top large piece is basically coming down to like our continuing operations. What are we in business for? So we've got our sales, less our cost of goods sold gives us gross profit, less our operating expenses gives us that operating income. But then we have other income that is still common: interest expense, interest revenues, gain in sales on our assets that we're using in our business, and then income tax expense. So all those are kind of normal in our day-to-day operations. Then we go down here, we see like discontinued operations. That's more extraordinary in nature. We're not doing that all the time. So we're going to segregate that. And then normally on the face of the income statement, they will calculate the earnings per share because it is a ratio that investors are interested in seeing. So our revenues are money coming in from selling our goods and services to our customers, and our expenses are money going out, what we pay for in order to produce those goods or prepare those services for those customers. So we like to try to match them up. We do a matching exercise where we're saying, okay, what expenses were incurred in order to create those revenues? If there is a relationship between them, we want to report them in the same period. If there's no necessarily direct like cause and effect relationship, then we're going to allocate it over into periods as it's either used up or incurred. We can also have gains and losses if we sell our property, plant, and equipment. And those are, again, things that we're not doing like every day, but it still relates to our operations. If, we have an old truck, we're going to sell it and get a new truck. When we sell that truck, we've got to record a gain or a loss based on what we got. And again, so here shows you just another example of kind of getting to that income from operations again. And like notice when you go down here to the other income, interest income, interest expense, and gains are all very common to have. But they are non-operating items, but they're very common. And then another example, again, showing you the same thing: operating, non-operating. And then a single step income statement is the easiest. It just totals all your revenues, totals all your expenses, and then you calculate your net income. The multi-step is more common, I feel like, excuse me, in industry, because it gives you a little more detail, especially if it's like a manufacturing company or a retail company, not necessarily a service company. So we've got our sales, less our cost of goods sold gives us gross profit. Then we subtract out our operating expenses, and then we deal with those other income to come down to what is our income subject to tax, and then what's our income tax estimate that we owe. So that, again, gives us just a little bit more detail, and I do think most companies use that format. Restructuring costs, again, are something that it would be more extraordinary in nature. It's not something that we do all the time, but we do hear businesses that do restructure. So whatever costs are associated with those plans to materially change the scope of the business are going to be classified as restructuring costs. So again, sometimes businesses will hear they're gonna like terminate employees and give them severance packages. They're going to close off their lowest producing stores or restaurants. All those are examples of restructuring. Then other unusual items. So goodwill. If we had goodwill and we estimated it to be a certain dollar amount, we don't like amortize it to expense over its life because we don't really know how long goodwill is going to last. So what we do is the auditors come in and test it and determine if it's been impaired. So if it's been impaired in value, then we have an impairment expense. That would be also an unusual item. Companies do have it because it's something they go through every year, that the goodwill test, but that doesn't necessarily always get impaired. Let's see. That's good. Then, like I already said, normally almost all companies have these two. They're non-operating items, but they're very common: interest expense and interest income, and then gains and losses. So then these companies that have non-GAAP earnings, so here they give us some examples: those restructuring costs, acquisition costs, the impairment of the goodwill or another intangible asset, stock-based compensation. So those are all non-GAAP earnings. And again, they're very discretionary. So those have to be disclosed. Discontinued operations, again, now you want to kind of pay attention to this slide. So what we do though is we net those things. Let me see if this one has it. Because then we'll net if we sold it. So like, did we have a loss up to a point and then we have a gain when we sell it? We'll net those things. I don't think this slide has it though. But then what we also have to do is factor in our income tax expense. So we're going to factor those all in to say, okay, if we have income from discontinued operations, net of the tax. So we always show it net of the tax. But then here, I think this is the one I wanted to focus on. So if you have income, you're going to add, if you have add or subtract a gain or a loss when you finally sell this discontinued operation. Because normally there's a point where you're operating it and you're losing money, and then you sell it and you might actually make money. So you've got to net those together and then show both of them. So then the same if it's not been sold, but we have an impairment loss, we're going to have to factor that in as well. We can change the accounting for, this would be a change in estimate, or I guess it could be a change in accounting principle. So it's a change in estimate that is achieved by changing an accounting principle. But how we depreciate, amortize, or deplete, that can result in changing our income statement. So we have to disclose that. If we have any errors that we discover in our financial statements, we have to disclose those. If it's in the current year, we just do a journal entry to correct it. If it's in a subsequent year and it's material, it's going to require a prior period adjustment, which will go into our retained earnings. Because again, the statements are already closed. We can't go back and reopen them. So it just is an adjustment to our retained earnings. And then again, we disclose it. Our earnings per share, we have the basic earnings per share, which is our net income less preferred stock dividends, if we have any preferred stock. We don't always. And then our diluted is when we have to adjust our number of shares outstanding. So the diluted part comes into those number of shares outstanding. So it's the same top, but it's saying, okay, we maybe don't have the common stock outstanding, but there are things that could happen that would result in those shares changing. So say we had like preferred stock that could convert into common stock. Say we had bonds that could convert into common stock. We have to show as if those conversions happened, what would be the shares outstanding and what would that do to our earnings per share, because they have the potential of happening. So here again, they show you the basic earnings per share, and then the diluted earnings per share. And what really changes is the weighted average shares outstanding. And then our comprehensive income is when it's gains and losses that we're not going to report on our income statement, and they're going to go into comprehensive income. And then we can have a statement of comprehensive income where, see, like down here, we have gains on debt securities, losses on our pension, and then losses on derivatives that we have entered into, like maybe to protect the price of the US dollar if we're doing international business, or say we're an oil and gas company and we're protecting the price of our natural gas, things like that. And then those will go into other comprehensive income. So we have some flexibility in how we show it. We can have a single continuous statement of comprehensive income where it shows it all together, or we could break them out into two separate statements. And then the offset of it goes into, our balance sheet. So it's a component of our stockholders' equity that shows that other comprehensive income. So here you see it on the balance sheet underneath our retained earnings, and then we see it up in our income statement, that's our statement of other comprehensive income. That was showing it as a continuous statement, because here it is showing it as a separate statement. But then it still ends up going into the same section, this accumulated other comprehensive income on our balance sheet. And then again, it's just saying that whether it was other comprehensive income or real income, our stockholders' equity section stays the same. It's just what line item would it be in. If it was real, if we actually reported it into our real income, it would reduce our retained earnings or increase our retained earnings, whichever way that goes. If it's just in other comprehensive income, then it's going to be in that accumulated other comprehensive income section. But they both roll into our equity section of our balance sheet, so that part isn't going to change. Then our statement of cash flows, again, kind of big picture. We are classifying our cash movement, receipts and disbursements, by what activity they are. Are they operating activities, what we do day to day? Investing activities, when we're investing in long-term assets, no matter what type they are, or financing. We're getting debt, we're getting equity, we're paying dividends. So you do want to understand like what constitutes an operating activity versus an investing activity or a financing. So operating are the things that deal with our day-to-day operations plus interest and dividends received, not dividends paid by us, but dividends received from our investments. Then our outflows are purchasing inventory, sales, wages, rent, utilities, anything that we're paying for our day-to-day operations, plus interest and income taxes. All those are considered in our day-to-day operating activities. There's two ways to do it. I believe that most companies use the indirect method, so that's the one that you really should be the most familiar with. The direct method is just classified a different way. So here we have, again, income statement and balance sheet, because that's our kind of our main items that we go back to when we're preparing. Here's the direct method. So we have cash from operations is cash received from customers, cash paid out for expenses, cash paid out for income taxes, and we calculate a total. Now they show you down here kind of how they came up with those numbers to calculate those, to put them into the statement. The indirect method is a little more detail. You start with your net income, you add back any non-cash expenditures, and then you deal with the changes in your current assets and your current liabilities. Because when your current assets or your current liabilities change, it's a result of either you collected cash, you paid cash, things like that. So we go through each line item and say, did they increase or did they decrease? And then that impacts our cash flow statement. Investing activities are things that change in our long-term assets. So again, inventory is not a long-term asset. So anything in our property, plant, and equipment, if we have stocks and bonds, things like that. So we could purchase those and those would be cash outflows. We could sell them and those would be cash inflows. So in a healthy growing company, you have far more cash outflows in your investing activities than you do anywhere else in your cash flow statement because you are expanding, getting bigger, doing more. Your financing activity says, okay, where does the money come from? So if it's an inflow, am I getting it through loans? Am I getting it through selling stock? Am I selling bonds? Is it when it's outflows in financing, I'm paying off those loans or paying off those bonds, or I'm paying my stockholders' dividends? All those are outflows in the financing activity. So here again is the investing, which normally is a credit. Financing can go either way. It depends on if you're really growing and you're borrowing money or you're at a more of a plateau where you're paying off your debt. Either one could be a healthy company. Then, because there are transactions that do not involve cash, we have a section called the non-cash investing and financing activities. So say we acquired equipment, just completely getting a long-term note. Cash never left the building. We're going to disclose that down in that section. And then our activity ratios, we have our asset turnover ratio, net sales divided by total assets, our receivable turnover ratio, net sales divided by our average accounts receivable, and then our inventory turnover, cost of goods sold divided by average inventory. Now notice when it says average, it means we have to add our beginning balance to our ending balance and calculate an average. Once we calculate that accounts receivable turnover, if we divide that into 365 days, that'll give us our actual collection period, which is in days. We can do the same thing in inventory as well to do an average days inventory. Take 365 and divide it by our inventory turnover ratio, and that will convert it into days. Sometimes days has more meaning than saying, oh, I've turned my inventory over 6 times. How many days is that? Our profitability ratios, again, are always what investors are looking at. So our net income to our net sales, how much of our net sales do we retain in the form of profit? Our return on assets, what are our assets making us? So net income divided by our total assets. What are we doing with our stockholders' investments? So our net income divided by our stockholders' equity. Those all, the higher the better. The higher the return, the better. I don't think you have to worry about this DuPont framework, so I think I'm going to skip that. I don't believe we have any questions on that. If we do, come back to this section, but I don't think so. Our interim reporting is also important. So that is saying that we prepare these statements quarterly as well. So we talked about the 10K, the annual report being a big deal. The quarterly reports are called 10Qs. They're less of a big deal, but we still prepare them. So each quarter we prepare those financial statements, the auditors review them, and then that way we've got a full year of data that you can kind of analyze and look at. And we still have to look at it for, what if there's anything unusual that happened in those periods, and discuss those as well, especially, again, like those major ones that we've already talked about. We'll do quarterly earnings per share. So again, we can kind of see how that stuff happens. If there was any changes that we are making during the year, we would disclose those as well. And at a minimum, this is the stuff that we would have to disclose in our quarterly reports. So basically our income, our earnings per share, any seasonal revenues, costs, and expenses, if we had any significant changes, any discontinued operations, any contingencies. So those are like lawsuits that happen. We would want to disclose those, any changes in our accounting principles, or any significant changes in our business. So that is our income statement. And again, the disclosures related to that.